Hey everyone, welcome back to Corporate Decoder. Today, BTMD just filed their second quarter 2026 earnings report, and I'm seeing one big number that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is facing some serious revenue challenges, and the reason might be buried in their supply chain. This is Biote Corp, a company that trains doctors on hormone optimization. They file these reports quarterly to tell us how they are doing financially. Let's dive right into the numbers, specifically their balance sheet. This shows what the company owns and what it owes at a specific point in time. As of the 30th of June 2026, their total assets were about $101.7 million. That is down from over $107 million at the end of 2025. On the other side, their total liabilities are pretty high at almost $160 million. This means they owe more than they own, which is something to keep an eye on. And because they owe more than they own, they have a stockholders deficit, meaning the owner's stake is negative. This is not uncommon for growing companies, but it highlights the need for careful financial management. Now, let's look at how the company performed in terms of making money. This is the income statement. For the 3 months ending the 30th of June 2026, their total revenue was about $44.2 million. That is a noticeable drop from over $48 million in the same period last year. For the first 6 months of 2026, revenue was down to $89.2 million from nearly $98 million in 2025. The biggest hit came from product revenue, which fell from $47.7 million to $43.4 million in the quarter. This is a significant decrease. Service revenue also declined from $1.2 million to $851,000. And this drop in sales directly impacted their bottom line. They reported a net loss of $7.4 million for the quarter, a big change from a net income of nearly $4 million in the same period last year. For the first 6 months, the loss was $4.8 million compared to a profit of almost $20 million in 2025. One of the reasons for the increased loss is a jump in selling, general, and administrative costs. These went up from $24.2 million to $32.4 million in the quarter, a nearly 34% increase. They also had a loss on extinguishing debt, which means they paid to get rid of old loans, costing them $648,000 in this quarter. Looking at the changes in stockholder equity, we see how these losses affect the owner's stake. The net loss of $7.4 million for the quarter directly reduced their accumulated deficit. They also repurchased some of their own stock, which is shown as treasury stock, further reducing equity. Now, let's talk about cash. The cash flow statement tells us where the company's cash is coming from and where it is going. For the first 6 months of 2026, cash from operations was only $2.7 million, a big drop from $13.6 million in the same period in 2025. This means the core business is generating much less cash. Financing activities show a significant change. They used $11.9 million in the first 6 months of 2026, down from almost $30 million in 2025. This is mainly because they refinanced their debt, bringing in new money, but also paying off old loans. They reported a net loss of $4.8 million for the first 6 months of 2026. Here is a crucial number, adjusted EBITDA, which is a way to look at profitability without certain expenses. For the quarter, it was $5.6 million, down from $15.2 million in 2025. For the first 6 months, it was $14.3 million, a big drop from $28.9 million in 2025. This shows the underlying business is less profitable. Why the drop in revenue? A big reason seems to be a voluntary recall of hormone pellets in January 2026. This impacted sales by an estimated $3.3 million in just the quarter. This recall also affected their costs. The cost of products went up because they had to switch suppliers due to inventory issues caused by the recall. Overall, the company's revenue is shrinking and its costs are increasing, leading to losses. The company's own risk factors section warns about the success of their dietary supplements and their reliance on third-party pellet suppliers. The voluntary product recall mentioned is a direct example of this risk playing out. Looking at the balance sheet again, their cash position also decreased significantly from $24.1 million at the end of 2025 to $11.2 million as of the 30th of June 2026. The net loss attributable to Biote Corp. Stockholders was $6.6 million for the quarter. This is a stark contrast to the $3.2 million profit they made in the same quarter of 2025. There are also some executive changes mentioned in the exhibits, like an amended services agreement with Mark Beer and an employment agreement with Bob Peterson. Brett Christensen, the former CEO, also has a separation agreement. These leadership shifts can often signal a company trying to navigate tough times. The company used $11.9 million in financing activities in the first 6 months of 2026. This was mainly due to refinancing their debt, which brought in $125 million for their term loan. But they also paid off old debt and incurred fees. The increase in selling, general, and administrative expenses was partly due to $5.1 million spent settling legal matters. This shows they are facing ongoing legal challenges. The overall picture for Biote Corp in this filing is one of declining revenue and increasing costs, leading to significant losses. What I'm actually looking for is a clear path to profitability and a stabilization of their revenue streams. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded, like, comment, subscribe, and join our Discord in the description.